Welcome back, folks. Good morning. All right, we're looking at the dollar index. Okay, let's zoom in a little bit here. And we were watching the range that I identified the last time we were together. And I mentioned how during this consolidation, they took price down below it into a 1-hour order block, which we'll look at in a moment. But we closed in this area down here, running sell stops below this clean trading range. This manipulation down here to accumulate more sell stops for buy orders to be paired up with. I mentioned that this was going to be just like they did with the stock indices, where we had a long trend higher. We moved into a larger consolidation. They dropped it lower into November for the indices, and then they slammed it higher on what they're calling the Trump rally. Well, the same thing occurred here. They manipulated price below the trading range, accumulated the sell stops. If the sell stop's going to be triggered, they're going to be selling at the market. Smart money's going to buy that up. Okay, and price rallied up. And we had our focus on this particular down candle right here. That was the one we're watching. We were watching, let's say it like that. And we had buy stops above the high here. They have since been traded through. And we had buy stops above these clean highs as well, and they were ran through yesterday as well. The level we were looking at was the mean threshold of this down candle. And if we dipped below it, which is what we're noticing here, that range from the open to the close, that's the midway point. I rounded it to the nearest 5 level. It actually comes in around 100.74, so I just rounded it to 75 just for clarity. I'm sorry, my OCD flares. I can't permit it to be 0.74. But the down candle here would have been the next objective. Should we have traded through it on a spike, that would have been the one to look for. But all eyes were on this one, and the expectation is where we're going to see price trade higher and make a run above that 102 level. As it happened, we actually traded into the 103s. Okay, so we're actually really only 75 points away from my 104 objective that I called about a year and a half ago. So we're looking at potential. It would be okay for it to have one down day or consolidation day in here. I don't see us ripping into 104s between now and Friday's close, but it could happen. I don't think it's going to, though. There's a lot of movement that's taking place on the heels of the Fed raising that modest little interest rate hike. I said if we were going to see it hike, they aren't going to make it any more than 25 basis points, and we basically, that's all we really got out of them. A little bit of a promise of more of it to come in 2017, and I usually keep this kind of stuff for the free member area and on my YouTube, but I'm just going to include it here because I just want it on record. I think what they're trying to do is they see Donald Trump, and everyone has their opinion of him, and I'm not trying to defend him in any way. I think he was a lesser of two evils between him and Hillary. But I think what's going on is they're actually they tried everything to get this guy not to be elected, and it turns out that he was elected. So we went through him being a racist to him being a womanizer to a touchy-feely guy. Everything you could possibly think of. Okay, and then now that didn't work, and they had paid rioters, okay, to come into areas and picket and run around with signs and F Trump and do all that business. That didn't incite any more participation, so that died. So now, obviously, it has to be Putin sat home in his basement and hacked our electoral process, and now we're, we had Donald Trump as a result of the Russian hack job. So Obama comes out and says that he needs to have this investigated, and he wants a response before January 20th. Well, what's January 20th? That's the inauguration for Donald Trump. And they have all these things in play where they're trying to, if they can't get him overturned, in other words, if they can't prove or give some kind of evidence, which they have zero, of Russian hacking, they went in and looked at all the counts and the recount states they did all the voting, they actually found more Donald Trump votes. So, if they're looking for Hillary to be, screwed out of the election, they actually found that Donald Trump should have gotten more votes. So I think personally, this is what I'm seeing on the horizon. I'm seeing that because the elections were so vastly one-sided for Donald Trump, and they thought for sure this guy, of all people, would never make it in there. I mean, he was a laughing joke all the way up through it. But now he's there. So what do we do? Well, the Fed, because it's not even anything to do with our government in America, it's a completely separate entity. And if that's a shock to you, do some research, you'll find out. They're actually doing whatever they can to try to manipulate the marketplace to justify the coming crash. They're putting in, and Yellen was like, it's okay. It's not that big of a deal anyway. Don't worry about it. That's it. Don't worry about it. It's not that much of a rate hike. When have we ever seen a Fed chairman ever come out and say, almost apologetically, don't worry about this. Don't worry. Don't pay any attention to this. We're just doing this. Don't pay any attention. Go about your business. It's not that big of a deal. What they're doing is they're slowly putting the stitches in place, and they're going to cinch it up tight. Okay, and then all of a sudden, it's going to be over. And I'm almost certain now that January 20th, Inauguration Day, if it doesn't happen the day before, the day of, or the day after, I think that's when we're going to see the crash. That's what I personally believe. I think that's what we're seeing the orchestration of. So, yes, we've seen the dollar rally up. Yes, we've seen the indices make all-time highs. Yes, the interest rate market's collapsing and rates are increasing, like I said months ago. All those things are fingerprints to what I'm describing here. They're all indicative of the very thing that I think may, and it's all opinion. I don't have anything to base it on except for what I just told you. That's what I see. So I think personally, until we get to January 20th, or let's just say the second week of January, and I think that's a fair assessment. I think until we get to the second week of January, we're seeing higher dollar until then. And that's going to squeeze all of the other nations. I mean, if you're overseas, you're probably seeing the impact of a stronger dollar now, and it's probably squeezing on you. But it's not over. It's going to keep going up a little bit more. I think we still see 104, 105, even 107 on a blow-off move. And these were all mentioned about a year and a half ago on YouTube. So you can talk about all of the things that may lead up to this or that, but it's pretty obvious that they're doing whatever they can while they have time to cause some kind of disruption. And remember, Obama promised that Donald Trump will not replace him in the White House, and that was not a joke. He meant it. He said it, and here we are. He's demanding that we do an investigation. And believe me, data and numbers and information, like anything else, if you torture it enough, it'll submit to anything, and they'll find something. They'll find something to say that Russia had something to do with the elections, and then that's going to cause all kinds of trouble. All kinds of trouble. Can you imagine what would be going on in the streets of America then? If they try to say, okay, we have to do it. We've never had a re-election like that. All the way up to the point, we've got to do a re-election now. This was not good. Let's do it all over again. That would be nonsense. But that's what they're actually considering. So think about that. That's the Wild West scenario I told you about over the summer. That's what we're seeing. It's happening right now. And they're trying to keep us distracted with all these other things. So whenever you see news events coming across your wires, okay, and it seems like a big event, take a step back and look, because what they're really trying to do is pull your attention away from what's really going on. And now, because we're getting going to the holidays, keep tabs on any executive orders that Obama signs in, because that's usually when he does all that stuff. New Year's Eve, Christmas Eve, he does all that business. And he's not the only one. All the presidents that have sly moves, they do that stuff when we're all distracted or sleeping or preoccupied with our wonderful holidays. So just be mindful and sober-minded going into that. So dollar, we're looking for a continuation, but it's not most likely going to happen from a straight line from here. We've already moved aggressively above our old high. I think if we get a consolidation day or two, maybe a little bit of a pullback, it wouldn't be out of the question to see it come back all the way down to the 102.10 to 102 big figure, and then make another run higher. On the lower time frame, we have, let's see, set this thing up so it scrolls over just a little bit. We've had a consolidation here. We expanded through the consolidation. What we're looking for is price to, if it wants to come back down, it can come to about 102.50. That'd be a good area to see some reaction as well. We have a little bit of a fair value gap between this down candle's high, which is 102.66, and this candle's low is 102.80. So we got a small little range in here, okay, that can be closed in. Price is only delivered on the upside, so we can come down to that and then see another run higher. If it wants to go below that, we're looking for 102.50, and then obviously we'd have to consider maybe a full return on the daily chart back down to 102.10, 102 big figure, and it still would be healthy for the uptrend. Euro dollar, we lost all of the, actually let me go back, I'm going to ask you a question before I go into this chart. When we have a fair value, gap, or if we have a liquidity void, okay, and I'm going to show you in graphic terms like this. Say this box here defines whatever that void would be, or that liquidity gap. If we have the range high and the range low, in other words, this would be some kind of a low in price, and this would be some kind of a high in price, and then in between that would be a move, higher or lower, doesn't matter. But there's only been price delivered on one side. In other words, a big candle. When price has done that, actually, let me do it like this. I'll give you a graphic illustration. And we'll say this is a down candle, just for the sake of example. And we'll just make this a little bit bigger. Okay, so we have price. This represents the one big candle, okay, that trades down. And then say there was a candle that had a low here, which we're drawing from, that would represent a previous one candle low, and then there'd be one candle high in here. So the delivery of price would only be that one big down candle. So we have this big range of liquidity gap. It could be in the form of a liquidity gap or liquidity fair value gap, rather. I'm sorry, liquidity void or fair value gap. When we look at that, what do we do with this information? Obviously, we can expect the price come all the way back up to close in that entire void or fair value gap. Or what's the other alternative? I'm going to ask, this is a part of the show where it's interactive. What would we do with that void? What do we do with it? Kane's already said it. Mark's out at Merlin. Very good. Man. Awesome. Awesome, awesome, awesome. You look for equilibrium. Okay, you look for equilibrium in the range. So while we know that there's a gap in liquidity, if there's a strong directional bias, it's not necessary. This is not necessary. And Matt, if you're listening, this is also part of a response to your email, because I know you asked me about gaps. So I'm going to include this as well, but there's a lot more detail with the teachings that you're going to have the remainder of December. What you do is you take the range of the gap, okay, that's defining where the price has only been delivered on one side, divide that in half with the 50 level we identify as equilibrium. Once you do that, okay, if directional bias is bearish, you look for price to come up just to that price point here. Then it has to show you willingness to go higher. If it goes higher, okay, at a time when you're expecting it to be a lower, higher time frame price move, lower, in other words, if the bias, if you will, suggests that price is weaker and it should be going lower, we reasonably only expect it to get to about the 50% level or halfway point of the range. It can come all the way up and close that gap and go lower. And trust me, this is all example. I'm going to actually pull off the whole thing in the euro dollar and explain it to you. But I want you to understand that when we look at price, and because unless we're looking at Sunday's opening or we see a big interest rate announcement, which we'll see a gap in the euro yesterday because of that, there really isn't a notable, clear, discernible gap seen in Forex. You don't see it because the price will close in and make that candle. It's 24 hours. It doesn't stop. The only time you see a gap is when there is a big, like a non-farm payroll event, or there is an interest rate announcement, that type of thing. That'll cause a big disruption where it'll be a massive repricing where price will be here one moment and then all of a sudden it'll open down here or up here somewhere. And there's obviously that's a gap. But in price action that's 24 hours delivered, you won't necessarily see a gap. So we have to go into price and study where those gaps would reside. And that's by seeing one big candle, okay, when price is delivered on one big candle one direction and there's no other candles in that same range, that's what makes the fair value gap or liquidity void. The difference is fair value gaps are usually very small. Voids are part of a larger range. And we'll have defining terms that really associate when to look for this and when to look for that. And break it down so you can have usable context, not just talking about broad brush terms like we're doing here. So if we had the equilibrium price point here, we could reasonably expect to see a candle move up or price move up into that range there and then wait for it to roll and go lower. What that would leave is the 50% of the range that we're identifying in the shaded area of this big down candle to where we marked out where that fair value gap or void would begin. When that is happening, when you see that, what we've done is, let me draw this little piece of business out here. And I can take this fib off. This would be equilibrium. Okay, or the mean threshold of the fair value gap or liquidity void. When it's strongly bearish, we would expect to see price trade up into that range here, hit that, and then cause some measure of resistance. Once it goes lower, what does it leave? It leaves this little area up here that didn't get traded to. What do we call that? That would be a breakaway gap. That's how you see a breakaway gap in Forex, where you otherwise wouldn't see it because there's no breaks, there's no session ends. It's just constantly delivered price. So when we see that area left open, it didn't trade all the way up there to close in that range. It only come up halfway. It leaves a breakaway gap, which means you're going to have to look for measured move ideas. In other words, if we've seen a larger move lower in this area of which where we created this liquidity void or fair value gap, if we get a breakaway gap in here, what that's done is it's given you a reason to say, okay, well, what is the most recent obvious price swing lower? Because we're probably going to duplicate that in another leg lower. It's also sometimes referred to as a measuring gap. Okay, so if you have a big move lower and you get a gap, you can take that. And again, same thing, you're looking for measured moves. Now, with all this said, let's actually go into the euro and you'll actually see what I'm referring to because this is already in our charts. All right, so let's zoom in here. All right, so this is the daily euro dollar. Let me zoom in one more time just for clarity. And one more time. No, that's all it's going to give me. Okay, so trying to find a little doohickey here that allows me to scroll over more. Because if I can scrunch up a little bit more, I'll probably be able to... No, it's not going to let me do it. I'll just work with this. We have this down candle's low, and we have this candle's high. That big candle on the daily, that's our gap. Price is only delivered on the downside. Okay, price has only been delivered going down. So what we do is we look back and say, okay, well, we had price delivered here, and it stopped. So what is that low? 107.01. So there's our range high for the gap, and we have price delivered here. Now, why am I using this up candle? I'm sorry, this candle's high. I'll tell you in a second, but the high is 106.29. So price has been delivered all down here, and then we had an opening here, and then price traded higher to make that wick. So it was delivered on the upside here, so we have to stop the range determination or defining of the range to that price point here, because price was delivered up to that point here, stop. We have it down here. So we have price from this close to this low is the same as this portion of this candle here. In other words, all this little price movement here, take that out, extend it in time. You can't use that for here because this has already been delivered twice. It went down to make that low here, and then it went down again to make this big candle. So price has already been passed through this little area here twice. So we look at the low here. This is the only portion of price where it's only been delivered on the sell side, only. So to rebalance price from an interbank algorithm standpoint, it has to do what? It has to deliver price on the upside. So it has to pass through on the up. So what we do is we actually define, we're going to drop down into a 4-hour just so I can zoom in a little bit more. Okay, so now we have that same low and that same high in here. We're going to define that by a fib. Not because there's magic in fib. All we're doing is measuring equilibrium. That's all we're doing. So the equilibrium level is here. I'll borrow this line down here. Okay, so there's their fair value gap and liquidity void. Price comes up, hits equilibrium, hits equilibrium, hits equilibrium. Notice it goes through just a little bit, but it leaves all of the 107 big figure down to 106.64 area open. So this portion of the range, in other words, let's do it like this so you can see it. This portion remains unfilled. Now we can take the wick here and say, okay, yeah, well, Michael, it actually did this. And that would be a more accurate statement. So the 107 big figure to this high on this down candle is 106.73. So that is a measuring gap or breakaway gap because it wasn't willing to fill that before it makes a new lower move or another price leg lower. How do you use that? Well, you take the range high up here. We're going to do two measurements. The range high, which is this quote candle high, 108.70, down to this low here. Why this low and why this high? This move is the extreme on a stop run. We're actually going to use the bodies of the candle in the next measurement. So we're getting a range extreme on the high and the low. That's the lowest of the low before it starts trading up into that gap. Let me put this back the way it was just so we can keep things germane. So we have this move here. Now we can take that same move here and just copy it. Hold down Control, double drag on your mouse. Place it right on that high, and this will project where price should go as a low objective. So we're looking for 103.25. Okay, so 103.25 with this being a measured gap. Another way of doing it would be this. Hang on one second. Okay, you can take fib, come on, I'm going to start putting my mouse on there. Okay, we get a measured move from this high down to this low. Excuse me. and we could see a move to, this will be really long term, 101.77. And remember, we've already mentioned before, months ago, that the goal is parity on the dollar. So that's where we're actually going to go. But these are the objectives, rather, that you could look for. Now, if you have your Fibonacci set with the 128 and 162 expansions, or extensions, rather, you can actually pull your fib from this low up to this high, and it'll give you 127 and 162 extensions, respectively. You can also look for those objectives as well. But my point in saying all this is, when we look for voids, don't demand, okay, because sometimes it's actually good if they don't fill in. If they don't fill in, that actually gives you prognostication about the dynamic of the future price movement. It'll give you directional bias. It'll give you suggestions that there's going to be a further advancement or decline in price. When we were talking about the dollar, that was the reason why I was looking for the expansion on the upside, because all these ideas where we had sell stops below the marketplace on euro, we had sell stops below the marketplace on pound, and we had obvious buy stops above the dollar highs, and we had a known area where we were studying. That's pretty good. I mean, that's really, really good. We had 2 days where it traded right into that ahead of the interest rate news, just to see it trade. Let's use a 15-minute chart. That's this level here, that 100.75 level. That's price hitting it here. Boom, boom. Apart from any other way of looking at it, you would have never seen this as a means of support and resistance that would be obvious to expect this type of move. But we outlined a daily bullish order block, the mean threshold, and we were looking for sensitivity around there. Now, I kept you on the sidelines because the interest rate market decisions can be extremely, extremely volatile. They can take the market one direction, 100 pips, and then slam it the other way, 200 pips. And as a mentor, as someone that was that you placed in a great deal of responsibility, I need to make sure that you're protected, because the making money part is easy, but keeping your money is the hard. That's hard. Keeping your money in your account is very, very difficult, because you start every trade with a loser. You're losing. You're underneath the dealer spread all the time. So you look at moves like this, and it's like, okay, well, why didn't I get a trade? Well, I can tell you, some of you actually participated, which is, great. If you had a demo account and you did, trades or whatever, great. I'm not telling the ones that did live trades, because I don't think that's something you should have done. But for the ones that actually did things in a demo account, kudos, very good. And you used the tools that you learned so far. Some of you sat on the sidelines and you watched and observed, and you learned some things just by watching it. Even better. That's exactly what I wanted you to do. Others are sitting there like deer in headlights. What the hell just happened, and where did this come from? Because you're so new. And that was the reason why I told every one of you to sit on your hands, watch, observe. This is not the last time you're going to encounter this. There's not going to be the only instance of interest rate announcements. There's going to be times when you're going to be in trades ahead of the interest rate release. And because you'll have built-in gains, you just wait it out and watch and see if your trade continues to show signs it wants to move in your favor. And if it doesn't, obviously you have to manage that trade accordingly. But sometimes if you're already, like in this case, if you've been bearish on euro, it's just a really nice event to take place. But it's also scary. And that was part of what I wanted you to watch. And I want you to see these things, okay, and see how fast and dramatic and sudden and relentless the moves can be. Because if you go in thinking, well, it's just an optimal trade entry or it's just an order block, it's not. There's so much more behind these types of moves that you just don't want to be in there just because you want to be in there. You have to know what it is you're specifically trying to do. And that means knowing where the market's going to be reaching for, knowing where the market shouldn't go. And honestly, when interest rate announcements come out, where you think they shouldn't go, take that out of the equation, because that's probably going to be where exactly it goes. They know where the majority of folks have an interest in. And not because of you or me. Our liquidity isn't even on the radar screen. But where the large pockets of fund liquidity, F-U-N-D, that liquidity, large traders, where their orders are, that's where the market's going to go. Right before the news comes out, when the interest rate announcement comes, that is where they tag that first. If you look at what happened in cable, we mentioned the higher high here. We were looking for a failure there. Price surged one more time yesterday. It didn't take out the high, but look at the price action that took place. All before the news event of the interest rate announcement. Rally, 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 holding consolidation, drop down, and one more time, boom, right above the old high of the day. This run right here, anyone that was already short, that's what that's meant to do. That's all that's meant to do. Right before it hits it, and then what happens? It slams down lower. That's very frustrating. And I'm telling you, I don't want to read the emails or the tweets or the direct messages on my forum. I mean, not my forum, but my free Twitter, because that's how people can still access me. And I don't want to read them because it gives them the impression it's a way of talking to me still. Go to email or use a forum link. But folks that want to go in here and just take action on it, they tell me, hey, look, I did a short. I would have been right, but look what happened to me. Well, that's all part of it. You need to understand that if you're going to be trading ahead of the interest rate news, you either have to have such small risk on and allowing a large stop, or just stand on the sidelines. And because most of you don't want to do a very small position with a large stop, you go in invariably and do what you shouldn't be doing. Trade a regular size position, and maybe you might go a little bit more on a stop, but you're not really reducing any leverage. You're going in there for the home run smash because you want that. You think that would be the answer to how you're feeling, and that's not what you should be doing. It takes a great deal of discipline to sit on the sidelines, especially when you know there's going to be a big move. When you know there's going to be a big move, so is non-farm payroll every first of the month. There's a big move happening every Friday with non-farm payroll, typically. But because there's a big move coming, it doesn't mean, well, let's get in there. It's casino time. I'm going to get in. I'm going to win. You could do that. You could very well do that. But that's not how you make a career. That's how you go to a casino and you bet and you gamble. And that's not what we do. We trade. We look for things that make sense, that we can define risk clearly and have a defined area at which it's going to reach for. If it doesn't give you that in a way where you can keep risk defined, or if you can't execute on the entry, then you either let it go or watch it happen live, or you don't have any live funds on it. You learn from it. You take in the experience of watching how price reacts, because in these events, they're literally going to where the liquidity is. We mentioned that the stops below on Euro. Below here. Sell stops right in here, below this low and below this low. They hit them. They ran right on through them. The buy stops, the sell stops on the cable, same thing. We had 25.50 sell stops in here, targeted. They cleared them out, came back up, retested. What did this move here, this small little retracement, what did it reach back into? I need to see what you guys are saying for this. What's this candle right here? Mitigation or breaker. What's it breaking? The short-term high here, where there would have been buy stops above it here. But it also sets the tone for this whole entire larger move it took out this high here. So return back to this candle's body right there. That's the retrade to the breaker or mitigation. So any long positions they held here, the send price is higher, they allowed them to take them off here. If it's going to be a mitigation of old longs, will price stay at that price point or that level long, time-wise? No. So if you see a quick and sudden movement lower and it breaks the short-term low prior to that retracement and it starts to expand aggressively, you have confirmation that it wants to go lower. Why not use this one here? Is that what you're asking for, Eric? Why not this one? Hey, Bella, stop snoring, girl. Hey. This one here, is that what you're asking for? This one, Eric? She's snoring, man. I can't have her distracting me. The next bearish one to the right. This one here is what I was talking about. Are you referring to this one? This one here? Well, this one's lower. This candle is lower than this one. So you always want to refer to where the lowest low was prior to the move up. That's the one you look for. And you'll have all that. Again, like I said, that's actually in December's teachings. You'll know exactly which breaker to look for, which mitigation block, and why to do it. But you always want to look for the lowest down candle to see a bearish breaker. That's the one you're looking for, okay? All right, so I'm going to put you guys back over here so I'm not distracted. So we see price expanding. And this is, again, it's the 4-hour chart. So we get a nice runaway after it hits the area of mitigation. So now any longs that were in, they're no longer net long. Now think of this kind of like, I'm kind of like stealing the thunder. Let me hold that thought. You'll know, just to satisfy when you get to the teachings. When I refer to institutional sponsorship, when we're using the breakers and mitigation, that's what I was going to comment on. But if I teach it here, it kind of like steals the thunder from the actual teaching. So I'm going to hold off on that. But when the price expands aggressively, you know it's seeking liquidity. Where's the area of liquidity at next? What's over here? We have sell stops below the market. We're going to use the body of the candle to define it now. So we have 2390 to 2380. So 2380 to 2390. It could bounce a little bit at 124 big figure. But yeah, that's that for the cable. Let's take a look at Euro. Euro's getting ready to run back down into the 103s again. Dollar CAD. I want to talk about this one because when we got down into this order block here, I stated that I would not be willing to hold on to it there. You can if you wanted to. It was up to you, but if it was going to go anymore, it would have been running the sell stops below these equal lows. The reason why I was suggesting that we were not likely to see a great deal of movement lower, and while this is the completion of the move, I thought I was wrong because when I was watching yesterday, it started trading lower. I'm like, okay, well, they're probably going to go down and take these sell stops. Then I looked at oil again, and if you recall, and I'm not a real big oil trader, I just noticed I followed it for a couple of days because I got a couple emails from folks that actually do trade it. When I gave you the insights about crude going above the old highs on the daily chart for Brent, that was a run on buy stops. And do I need to show you a chart to talk about this? Am I losing any? Because I'm really taking a great deal of liberty. Okay. Yeah, you got all right, well, since we're talking about CAD, let's do that. Let me hang on one second here. Let me pause the screen so you guys allow me to get to daily chart of crude, and it'll give you the reasons why CAD did what it did and why I was, hey Belle, hey, mama, wake up girl. Alright, so we're going to go to crude. I said Brent earlier. I don't know why I said Brent, but we were actually talking about WTI. So sorry about that, Neil. All right, give me a second here. We're almost there. That's the chart up with candlesticks. All right, so now we should be, or you should be, seeing the crude oil chart. And again, okay, so we had equal highs here. I hate putting my mouse over top this chart because it makes that little box jump all around. We had the old highs back here at 53.58. We had the highs here at 52.74. And this high here was 52.68. So we had equal highs in here. And last time I talked to you, I showed you a chart with the 6 months of data. And we were down here, and I said we were going to make a run up into take out these equal highs. What's above it? Buy stops. While I was stating that, I said, when we see this, we're going to see a participation in the Canadian dollar as a result. So with crude oil trading above, taking out the buy stops here, and then now receding back into the range, that frees up Canadian dollar to get in sync with, let's go back to the Forex charts. Now we can see price now trade in favor of the direction seen in the dollar index, and that's why you're seeing this extrapolated move here. Now, on the upside for dollar CAD, depending upon what OPEC does, now OPEC's trying to also put some squeeze on daily production of oil, so they may keep price below this consolidation. So if we see that, let's do a real quick equilibrium study on it so we can see where we could still trade up into it. I'm defining this high and this low of this trading range. See how price has been sideways? It could go all the way up to 134.83 for dollar CAD. If it trades above 134, no, if it trades through 135.20, then we're going to make a new high on dollar CAD. But reasonably, it could go to 134.83, continue up, and it also closes in a little bit of this fair value gap in here where price has only been delivered on the downside. So again, that same thing we just talked about here, the high 134.81 and the low on this candle 34.96. And you're probably saying, well, that's not a big range, Michael. What's so big about that? It draws price up into to close that little pocket of delivery on price only being offered on the sell side. So price could reach up into that level there, close that in, and then has a little bit more retracement. And then we can measure and see if it's going to be another continuation higher back. I suspect that we are going to see dollar CAD higher longer term. Dollar CAD is directly related to crude oil because Canadian export, number one export is crude oil. Yeah, and French DNA mentions that U.S. CAD bounced off of a bullish order block on the monthly chart right to the pip. Booyah. So the other market I wanted to talk about, and I didn't get a chance to go through because I've been busy making all of your slides for your teachings for this weekend. Dollar yen. Now, I don't trade yen. You know that I don't like it, okay? But dollar yen, I did discuss that in a teaching, and I used, I think if I'm not mistaken, I was using it as a chart where I didn't give you any of the price point data. I didn't give you any of the time axis or the price axis. I just let you look at price. And I can't recall what teaching that was, but I was showing you, I said, now if you looked at this, and I showed you all of a sudden it was the monthly chart on the dollar yen, and then it was the weekly chart on the dollar yen. I just don't remember exactly what teaching it was, but it was provided to you since we started in September. But in that teaching, I actually tell you, yeah, I'm looking for it too, Mike. I know I have it. I just don't know where I have it at in the teachings. I don't think it's in the actual 8 teachings that I do. I think I did it as a supplementary teaching. I'm almost certain I did it as one of those. I just can't recall what it is. But anyway, it's the one where I'm actually teaching without any price on the left side or any date references, because I didn't want anyone to see what it was. I wanted you to be more focused on the candles and the delivery of price. And I showed how much of a price move it would be by looking at it like that, using a monthly chart. And I gave you objectives to look for at the end of that. I said, okay, ultimately I think that the dollar yen is going to go here. And if you look at it, where am I at here? I thought I had it. There it is. There's the 118s on dollar yen. Okay, so this massive price move on dollar yen was all basically mapped out in teachings that I did with that. I just can't recall off the top of my head what it was. So now I'm going to have to find that this weekend. I will not be able to sleep until I find out which one it is. But I talk about why dollar yen should be going higher and to where it's at right now. So it's in your teachings. I just don't recall exactly which one it is, but nonetheless, I did similar things with the dollar Swiss, because I like to toss in ideas that, obviously I'm more prone to trade the euro and I'm more prone to trade the cable. Once in a while, if I'm a deviant, I'll trade Aussie dollar and dollar CAD. But some of you don't want to have those, and I don't want to place those shackles around you and around your mind that you don't trade yen because ICT doesn't trade yen. Because if you do that, you're actually stunting your growth. And the objective of this mentorship is to make all of you better traders than me. And I'm interested in that. So I gave you all of the things that lead to like where we're at now with the dollar Swiss. It would be, I know I did a teaching on the dollar Swiss. I got to start doing better notes on our teachings. I got to start doing like a briefing next to the video or a description. That'll help me find stuff, and it'll also help you, because I just had one of the other mentors, students, ask me about a video that was done in November with the interest rates, and at first I couldn't recall which one he was talking about, so I had to spend a little bit of time researching that. So I got to do a better job in that. So this is really highlighting a shortcoming on my part, so I got to be more diligent about making sure if I'm talking about something in a specific teaching, I want to kind of like have some keywords. Andreas is saying that the Swissy teaching was September, so I thank you. Thank you for that. Yeah, I think so too, Dave. I think a short description. If one of you guys that like Blind Frog and Thor, if you want to keep a running description also in the forum, that would be awesome too. I could take yours and just cut and paste it right into the videos when I'm doing it. That'll save me some time. Since you guys are viewing it, the things that should be popping off, if it's not in your keyword description, I'll add whatever I think you should be also taking from that teaching. But anyway, I'm diverging from the delivery of the content I want to show you today. The stronger dollar, obviously, is going to have a greater impact on foreign currencies, and it's also going to have an impact on stocks. It's going to have an impact on commodity prices. And I think if we get the turmoil that I think is being set up for the Trump inauguration, here's the thing, and this is what I'm excited about. And I very rarely ever get excited about trading. Like, I don't get passionate or emotionally committed to, fearful or exuberant. But right now I am. I mean, I am really getting excited because come either direction, it doesn't matter if Donald Trump gets screwed out of the election and they have to do a recount, which is going to be unprecedented. And if they do another election, that's going to be crazy. I mean, they're going to be burning buildings everywhere. But if they don't, and say he gets inaugurated on the 20th of January, as he should, either way, this is a loaded deal. Because I think, personally, we're going to see so much price movement on the back end of, in other words, from January 21st through November 15th of 2017, and I'm only pulling that out because it's towards the end of the year. That's usually when I'm starting to peel back my amount of trading. That period of time, we're going to see so much movement. I think we're going to be back in that 2007 and 2009 range of price action. I think that's where we're going. I think the volatility is going to be so massive, and if you aren't prepared for that, you're really going to be hurt. But if you go through what I'm going to teach you in December content, it's going to prepare you for all of these wonderful setups that are coming that are just going to be easy pickings, really, really easy when the ranges expand and go crazy. When we're in these small little tight ranges like this, you have to be very, very nimble on the lower time frames. Okay? Like when you're looking at this whole section of price action, say I was a Swiss franc trader, which I used to be when I was a commodity trader. If I was a Swiss franc trader, in this price action in here, just as well as you would be, you are forced to be in the lower time frames. And for those of you that are in the mentorship that are already identifying that you can't be an intraday trader, that you have to be on a higher time frame, you can't do very much in this until we get something like this, or we come back down to a bearish candle, which is a bullish order block. Why is that important? Because this high here taking out this area of buy stops. It pulls back down into an area of what? What would this be referred to in the teachings I gave you from last week? What type of liquidity is this move back into here? And there you go, internal range liquidity. So you're turning back into here, which means what? You're not expecting it to trade lower. You're only seeing it come back down into a previous order block to do what? To make a run for this type of liquidity, which is what? Anything above the highs would be what? External range liquidity. Now here's a tip. If you continuously see external range liquidity being tagged, what are you actually seeing in terms of institutional order flow? In this example would be what? Institutional order flow is what? Bullish. Very good. So that way it builds your anticipatory price skills. You know what you're looking for. And if you know where the market should go down to and then expand up to, then you'll know what type of trading patterns to look for. And you'll filter out other things, which allows your reticular activator system, okay, to come into play. And the things that you look for in hindsight and study, which is what you should be doing all this time, you'll see them jump off of the chart and say, okay, now that's a signal. This is a buy. Or, no, I'm not. Your brain will allow the sell signals to come in because you can focus primarily on what you're looking for because you're now in line with institutional order flow. Bullish. We call dollar higher, so that means we don't want to focus so heavily on sells. You're more inclined to be focusing on buys. And when you do that, it's very rewarding. And literally, in the last 2 weeks, I've gotten so many emails from the folks that are in here. And don't be discouraged by this. If you don't feel like this, don't be discouraged. I'm not saying this to belittle you or make you feel like you're behind. It's all going to be an independent timing theme. That's why I'm taking 12 months to do this. I'm guaranteeing you, you can have this in writing from me, okay? I'm guaranteeing you that you will know how to read price action and find your one setup by the end of 12 months. It's going to happen. But some of you have already got to the point where you know what your model is right now, and that's amazing. And I said some of you are going to have it by the end of the 4th month. Some of you have already got to that point and haven't even delivered the 4th month's content yet. That's encouraging for me as a mentor. But I have not lost sight of the folks that have not found their footing yet. And it's normal for you to feel this. It's normal. It's absolutely normal. But when you get through the December content, you're going to be probably right where you needed to be at all along before you even started the mentorship. So you'll start seeing these things in the charts and say, oh, now I get that. I see it. But when you see these things in a defined way, you'll be able to reach for it. Okay, just like an artist, okay, a painter knows when to grab a specific type of brush, a fan brush for certain effects on the canvas. Other brushes deliver the paint in a very fine-tipped brush, goes in and gets the details. Well, that's what a lower time frame setup would be. Broad brush, where he just completely covers the paint with a background coat, he could use a big wide tip brush and deliver that paint. You can't really get refined edges, okay, and refined entries or delivery of paint with that big wide brush. So just like that same analogy in your delivery of price, when you know what tool to reach for and why it's useful then and not in other times, you'll have a clear pathway to know what it is that is going to be you as the trader. And it didn't take me to tell you what it was. It's you defining yourself. At the end of this month here, you'll know what type of trader you're going to be. You will absolutely know that. Guaranteed that's going to happen. You'll know within probably the second to the last video, before the 7th video, you'll know where you're going to be at in trading. You know what type of model trader you're going to be. You're going to be a short-term trader, swing trader, day trader, scalper, or you're going to be a position trader. You're going to know it. And it may differ from what you think you are right now. And don't be surprised. But if you feel that tug be drawn into one type of trader and that model and that specific approach to trading, don't resist it. That's the worst thing you could do. Don't. If you feel led to do one one specific way of trading, chase that. Go right into that, okay? Because even if you don't live there as a career trader, it will give you the grounding or foundation to propel you into what you really will settle into. You may think right now, I really want to be a day trader. I like it because I don't want overnight risk. But when you get in there, you're not going to be able to do it. So what does that mean? Does that mean you can't trade altogether? No, it just means you probably are a better short-term trader. And what you're fearful of holding overnight can be overcome by lowering your leverage, widening your stop, and just relaxing a little bit. But you don't come to that conclusion until you go in and you experience the thing that you're being drawn to first. Then you encounter it. You engage it. Say, okay, well, I tried day trading. I can see it work sometimes, but I just can't do it all the time, or I just can't do it because of time. I just can't do it. Okay, no problem. But you probably can do a short-term trading approach where you get in there and you still use the same time elements where we look for the entries around London or we look for an entry in New York, and you hold on to the position for a day or two. There's nothing wrong with that. Again, the profitability is the objective, not being a specific predetermined model trader. I'm going to be a day trader. I'm going to be a swing trader. I tried that, and you can't force that. I wasted too many years initially trying to mimic Larry Williams, and I wasted my time doing it. I wasted it. I tried so hard to be something I wasn't cut out to be, when I just would have just relaxed and said, okay, I feel led to be a day trader. He doesn't want to be a day trader. Now, he's made money as a day trader, but he moved away from that because he doesn't have that strong set of intraday price action study. You know, I've made jokes about it in the past. He doesn't know who's buying below the opening on an up day. I do. But the point is, he excels as a short-term trader. I can do both, but I excel as a day trader. That to me, because I can see where the market wants to go, right down to the last 5 minutes. And I can see where the price is going to end, all that business. If there isn't a setup that gives the lion's portion of the move in the day trading capacity, then I will adopt the short-term trader. And that's the other avenue where I can go both ways. But that's where I excel, very short-term to day trading. I don't excel as a swing trader because my mind changes too frequently, especially now because I'm in here, I'm dealing with 800 people's opinions. And I've already told you in the past that when I was living with my uncle as a young man, his opinions or his trades would cause me to have a contrarian opinion immediately because I attributed him as being wrong. I have a narcissistic perspective about myself. And that's a character flaw, yes, but it's also a strength. By me observing it and identifying it, I know now that that's a problem for me. So when I'm inundated with opinions by other people, I'm immediately looking for the opposite reason to do what I'm hearing someone else tell me they're doing. I'm looking to fade everybody else. So I forgot where I'm going with this, but the point is I don't want to be a hindrance on you like I was allowing Larry Williams, to be for me. Great respect for the guy, all that business. I learned a lot from him initially, but I evolved beyond that. The stuff about, his accumulation and distribution ideas, while you can't readily see it in price so much today, I think I adopted a better version of seeing real accumulation distribution by looking at things like the dollar against other currencies, interest rates against one another. You won't find that anywhere. And I had a question the other day. I think it was last night or maybe yesterday. I just didn't see it until just recently. I responded saying that the person in our group said, "Is there a book about interest rates that they could read?" And the answer is no, because they keep it so. I guess the word they want this to be a. Yeah, there you go, though. Interest rates are the key. If you understand interest rates, you'll understand all the markets, every asset class. You'll understand every single one of them on a long-term perspective. If you understand what the interest rates do and where that fingerprint is for the smart money when they come into the marketplace, it's with the divergence between the 30-year, the 10-year, and the 5-year. So when we see that take place, you're actually seeing professional accumulation and distribution in the marketplace. There's no other discipline out there that talks about that. There's no other book. Believe me, I would love for you to be able to be told by me, say, hey, look, buy this book, and it'll tell you all about interest rates, and then I'll tell you how I take that and I use it in Forex. That would save me 16 different videos that's going to happen probably between now and the end of the mentorship. It would save me all kinds of time, but it doesn't exist. I read over 2,600 books, and I'm telling you, I invested a lot of time and money in everything that had to do with the bond market, interest rates, not just U.S. interest rates, but global interest rates. I know debt instruments. I know it. That's where I made the bulk of my money. When I was a futures trader, commodity trader, my focus was on the bond market, and I would be a deviant and trade the S&P once in a while. But bonds have a built-in advantage because what do you measure the S&P against? The Dow and the NASDAQ. But the NASDAQ, unless it was the tech boom, it has always been a laggard. It's always the laggard. Okay? So you always have a built-in a crutch where there's always going to be some kind of a divergence if you're using Dow theory. But in the interest rate market, it's pure. It's unadulterated. It's perfect. It's a perfect market. It's perfect. So if you measure the 30-year, 10-year, and 5-year, when you look for these divergences, okay, and you'll get it, TM. I know you're saying you don't understand it, and that's all part of what you're going to learn, okay? But I can't give you everything. I can't just dump it all out of my head and put it in there. I got to give you pieces of it, and then it'll make greater sense. But when you're looking for ideas for the market to move higher, for instance, if you're looking for the bond market as a whole, and you start with like tracking the 30-year Treasury bond. Let's take a look at the bond while we're talking about it because it's salient. If you want to find big moves and you want to be looking in the marketplace for things that set up, moves that have a lot more time behind them where, I understand most of you can't be day traders and some of you can't be short-term traders. So you need to rely on higher time frame charts to give you a position, hold on to it for a couple of days, and you're not worried about these little 5-minute, 20-minute, or even hourly chart moves, okay, because you're trading off of the daily, okay, and you have a lot more range incorporated in your stops, so you're not worried about all that. Let's take a look at the bond market real quick. If I could go back in time, okay, if I could go back in time and change one thing about my trading. And I was on Tom Dante's Periscope last night while I was working on my slides. I was listening to him. Every time he goes on Periscope, I go in and listen, whatever he's talking about. Some of the things he says is funny. But I asked him, I said, does he have any regrets about his coming up or his trading? And initially, I think he was trying to avoid saying he didn't regret anything. But if you look at his reaction and his recording, he definitely had some things that was on his mind, but probably didn't feel comfortable sharing. And that's cool. I'm going to tell you, I have things I regret. Okay, I regret a lot. Okay, there's a lot of things I regret doing. But if I had a literal time machine to take myself back in time, and I could sit across the table and tell myself something, the one thing would be, now before I say what mine is, ask yourself that question. If you could go back in time, what would be the one thing that you'd go back in time and tell yourself to do or not to do? And then you would feel confident that you would be a much better trader. For me, I wish I would have been told the strong importance of understanding what I thought I was seeing initially, but I didn't attribute too much to it. I was looking at the divergence between the different interest rates, and I used that to time my S&P trades. That was my S&P trading system. You're learning that when we get in the commodity section. Literally, I can show it to you in one teaching. It's all one delivery. I don't need multiple teachings to do it, okay? And I don't need to do it with my bond trading system either. You're going to learn. It's all one teaching, one delivery of one video. No modules, no multiple things. But what I was using to help, and Gate Trader, okay, I was teaching him S&P trading back then. And I told him, I said, look, you want to be looking for the bond market, okay, to create these divergences between the different interest rate, 2-year, 5-year, 10-year, and 30-year. We used 4 of them back then. And I've since removed myself from using the 2-year note. I use only the 5-year note, the 10-year note, and the 30-year note. And what I was using for short-term perspective only, and Gate Trader will validate this. If you listen, go on the forum and just say, hey, look, that is exactly what I experienced with Michael. This is exactly what he was teaching back then. And while it was great, it was useful for intraday trading, I did not understand the application and the importance of taking that on all time frames. And if it gave me the insight I was using for intraday price action that was precise with the S&P, it wasn't until 7 years later, I wasted 7 years not doing this. Now, I've been trading now, over 23 years now. If I would have known what I'm about to tell you right now, I am confident I would have over $150 million right now. Easily. If you understand the relationship of that 10, 5, and 30-year note on the bond markets, that will give you every significant price swing that you're ever going to trade, ever. That signal, that divergence, okay, between those 3 interest rate markets, when that occurs and you have a bias that supports that, that's what you have to have. You have to go into the marketplace expecting something. Like we were expecting the dollar to rally. Okay, so if we're expecting the dollar to rally in the futures market for the bond market, the 10-year note and the 5-year note, you're going to see a divergence in the highs. They're not going to make a higher high equally, okay, while the dollar was making a lower low 2 days ago when we were trading at that mean threshold and that daily candle that we were talking about. When that occurs, you're actually seeing that elephant, okay, that we proverbially call smart money. They are not just placing their foot in there. They're jumping all the way in. They're just plunging in. They have to go in hard because it's not going to stay there. So they're going to do as much as they possibly can, which causes a massive displacement. And what happens in the dollar? It rallies up like it did. What happens in the bond market? The bond market trades lower. The 10-year trades lower. The 5-year trades lower. What happens as a result? Crude oil trades lower. What happens as a result? Equities fall off. What happens as a result? Foreign currencies sell off. So when we have all these things together, if you go back through all your charts, and when we go into the commodity section, we teach this. For now, because that way, we're going to be talking about this months from now, and some of the data won't be able to be seen as freely and efficiently as it is now. But go in and look at all these significant moves that's taken place in the last 3 to 6 months. And then every time we see a significant price move going forward, I want you to take a look at the relationship of the bond market between the 30-year, the 10-year note, and the 5-year note as it relates to those price swings that we see in the dollar index, the crude oil market, and the foreign exchange market, and equities as well. You're going to see there's a recurring theme that if smart money's really going to be behind a move, okay, let's say, say I'm a euro dollar trader, which I'm not predominantly only, but let's just say I am only a euro dollar trader. If we say, okay, I'm going to be looking for a buy in euro, or I'm going to be looking for a sell in euro, you may have never even considered looking at the dollar index, but you have whatever your principles are that you use to trade it. That is, in my opinion, too myopic. You might catch some moves once in a while, but ask any specialist that deals with just one commodity or one currency or one asset class, okay? They were going to be consistently missing the big moves because they're only looking, they have their nose against the tree and they can't see the forest. You have to take a step back, and the biggest, broadest brush view of the marketplace begins with the interest rate market. I said that the interest rate market was going to collapse the middle of this year. I even specifically, you ask Tom Dante if I did not tell him personally that debt instruments are going to collapse. Be ready. What are we seeing? Now, am I beating my chest saying I called the top of the market? No, I'm not. Absolutely not. But all the indications were there that the move was to take place in the debt instruments. You're seeing it. It's unraveling. That's going to support a lot of other ideas that take place in the marketplace, in commodities, in stocks, in foreign exchange, in metals. Okay? If we see interest rates diving like this, what would you expect to see in precious metals? What direction would you expect them to be going in? Everybody, it's a mixed bag in here. The bond market trading lower, okay, which means it's going to be higher interest rates. If there's going to be higher interest rates, that means it's going to be a higher dollar. If the dollar is going to go higher, that's going to do what? It's going to pressure gold. It's going to pressure silver. So it's going to be hard for precious metals to rally and easy for them to decline. So all these things come together and they create an objective view, a macro view of how we go in as a trader. It's okay, I understand that underpinnings of the marketplace is a strong dollar. It's confirmed with a weaker debt instrument market, like the bonds are going lower, which means it's a higher interest rate. As the bond market trades lower, that's actually an increase in interest rates. And that was a confusing thing when I first started, but it's not so hard once you understand it. But if we understand the relationship, okay, now think, if we're looking for smart money participation in the marketplace, we're looking for evidences that this little move or that move that we're looking at, is it really being driven by smart money? Is it bank driven? Is it institutionally sponsored? That is always going to be answered by you analyzing the 30-year, 10-year, and 5-year note. Now, what do I mean by that? Go into your day trade. Go into your day trade and see if there is the divergence between all three of those interest rate markets. If you're seeing an hourly chart show a failure swing, in other words, if you're looking for the dollar to go higher, okay, you're going to be looking at the highs on the interest rate markets. And if they fail to make a higher high, that's confirming a buy in dollar. And if it's a buy in dollar, that means it's going to be a confirmed sell in foreign currencies. You start with that perspective and you work down. So it's not just a top-down approach, it's a macro view to micro. And you go into it with this idea saying, okay, if there really is participation on the part of smart money, if there really is, then it should be seen in the interest rate market, because that's where they're all going to start. Interest rates lead the market. They are the ones that call the shots. Long term, they dictate the delivery of where prices are going to be for a currency or a country. It's all interest rate driven. Near term, short term, it's liquidity based. Short term time frames, it's all the open float. In other words, where is the liquidity at right now? Price is going to seek liquidity on the short term time frames. But long term, price seeks yield. Wherever the interest rates are going or wherever they are, that's what causes these long-term price moves on the higher time frame. So if you get both in sync, and what I mean by that, if you go into the marketplace and you're looking for ideas to support stronger dollar, weaker bond, if you see that, and you also see the lower time frames indicating that there are sell stops below your currency pair, and we're going to go back to that analogy that you're only a euro-dollar trader, you got to identify where those sell stops are, because longer term, interest rates are increasing, causing the dollar to rally. That's going to put pressure downward easily on foreign currencies, and euro-dollars, foreign currency against the dollar. So your focus is going to be primarily on seeking liquidity below the marketplace or sell stops. If you understand that, you'll know that bearish order blocks, runs on short-term buy stops, or returns back to fair value or liquidity voids that are above current price action, they set up new selling scenarios. And you wait to see price expand to take out sell-side liquidity or sell stops below the marketplace. That is the nature of what you look for and trust in your directional bias. That's what you look for your trend direction. That's what you look for high probability setups. And anytime you trade against that, you're going against the grain. And while you may get some little moves here and there, and you may get a short-term pop once in a while and feel good, you beat your chest, and all of a sudden it turns around on a dime and blows the other way, you won't talk about that to anybody on the internet. But inside you're thinking, wow, this could have easily blew up in my face. And you know exactly. Give me a number one if that's ever happened to you. You did a trade and you knew you should have been not going in that direction, but you made money, and all of a sudden the thing, boom, it blew up the other way, and you're like, whew, man, I dodged that bullet. Yeah, it's unlikely for that to happen to you if you go into the marketplace like I'm describing here. You'll actually find those occurrences actually in your favor many more times than surprising you. And that was one of the things that I wish I could go back in time and tell myself and say, hey, look, Michael, you were really onto this. And you should have did more research by taking that application of using those varying interest rate markets and looking for that divergence between them. It wasn't just applicable to day trading. I thought that was the extreme of it. Now, the reason why I only thought that is because I was blending what I learned from Larry Williams in relationship to the open and close. He didn't give me any insight, and anybody that has any of his old videos, his Confidential Millionaires trading course, or his Money Tree course, or Batting 1000 trading course, or his short-term trading video that you can get on eBay if you really look hard enough for it once in a while. The only thing he talks about is the same thing. The opening price is usually near the low on an up day, so he wants to be buying near the opening. But what he does is he takes 20% of the average daily range and adds it to the opening, and then he buys up there. Well, I tried doing that and I lost money. What I learned from George Angel was the relationship of looking at the trend, the TRIN, the bond market, and the three major averages and the cash market on the S&P. And by looking at that, I was like, well, why is he making me look at the bond market? What was so significant about that? And I was just playing around with it, and I was like, well, why didn't he use the 10-year note? Or why didn't he use the 5-year note? Why didn't he use the 2-year note? And I plotted them across, my chart on Metastock one day, and I was like, this looks like an indicator. Like one would go down, but, I'm sorry, all three of them would go down, but one wouldn't go down. I'm like, that's like a stochastics divergence, bullishly. And let me go back and look at the charts. And all of a sudden, every significant price swing intraday for the for the S&P, when that happened, it supported the buy in S&P. Now, I didn't find that anywhere. It's just because of me just playing around with data and saying, wow, there must be something to this. And I literally made my whole S&P system off of that. And it was 85% accurate. It just was like all the time, boom, boom, boom. And I would only trade buying on Monday and Tuesday. I wouldn't do anything on Wednesday, and I would sell on Thursdays and Fridays. And where did I get that information from? Larry Williams. That's it. You buy on Mondays and Tuesdays, and you sell on Thursdays and Fridays. And because, I didn't want to be a seller, I predominantly was just a buyer only on Monday and Tuesday, and the rest of the week I was off. On Thursdays, I would be a bond trader. Tuesdays and Thursdays are really good days to trade bonds. I don't know why. That's just the way it is. But nonetheless, I wish I could go back in time and tell myself the power of what I discovered using the interest rate markets like that. It wasn't limited to just intraday price action. Because I was new, just like every one of you guys in here that are new, I only had the ideas that were given to me by other people, which was Larry Williams, George Angel, and Ken Roberts. And believe me, collectively, they're not that good of a brain trust. They're not. So while one of them did an extraordinary feat trading in commodities, he's an admitted poor trader. He'll tell you to your face he's not a good trader. So he relies on mechanical things to get him in and get him out. So what I took from a floor trader, George Angel, he actually was a floor trader for the S&P market. I took what he saw and what he deciphered and what the pit traders would see and how they would really run stops. Okay, they would work together to run stops themselves. They were the ones that were playing the market maker role. The pits were the runners then. So we don't have that anymore, especially we don't have it in the foreign exchange market. But those same theories and ideas are there, and they're just under the market, and you have to dig them out. But when you start looking at the importance of interest rates, and you say, okay, if I can see participation in the bond market, and it's clear that there's a divergence between those three time frames, the 30-year bond market, the 10-year note, and the 5-year note. What you're actually seeing is the participation of big institutional players coming in. It would be one thing to say, okay, and this is what when I taught it to one young man that actually worked at a investment firm back in 2002. When I was teaching him this, and I was teaching him actually my bond trading system, he was like, well, Michael, this is going to be a natural occurrence for them to diverge. There's really nothing to it. Now, he said this without actually looking into it. And I told him, I said, one would reasonably expect that to be the case because they're all different time frames. You have a 30-year benchmark bond market. You have a 10-year note and a 5-year note. Naturally, there's going to be some diverging price action. But the key is when that divergence occurs at a moment when there is an underlying idea, the bond market signals this as a confirmation. In other words, if we're bullish on dollar, there should be a failure swing at the highs in the bond market. If that occurs in a coined term that Larry Williams gave in one of his books, you have a lead pipe cinch deal. Now, his lead pipe cinch deal was when there's a market in a premium, commodity COT data was net long, the trend's been bullish and open interest declines. Okay, that's a lead pipe cinch trade. That's an easy buy. Buy it. Well, in terms of identifying where institutional sponsorship comes into the marketplace, a lead pipe cinch trade is when you see that signal occur, like I've shown you so far in the mentorship. If you see that develop in the bond market between the 30-year, the 10-year, and the 5-year note, that is like the biggest neon sign that you've been looking for in your charts. That's like saying, yes, what you think is about to occur in the marketplace is valid. get all over it. It's on it. Okay, it's going to move. If that occurs and you see price action supporting it, don't be in a rush to take profits right away. Hold on to it. And again, to use a term Larry Williams used, when you buy it, wrap your arms around it, close your eyes, because you don't know where it's going to go. It's going to go well beyond where you thought it was going to go. And they're really, really fun rides. They're great. They're awesome. But you can't get to that if you just trade just on price action alone. You have to look at some things comparatively. And comparative analysis, where we take related things, and it's the same approach like we talk about when we use Dow theory for the equities. S&P 500, NASDAQ, and the Dow industrials, they should be confirming making higher highs and confirming lower lows. If you don't see that occurring in fall, between September and November, then you're probably seeing the seasonal low. But then you go in, you look at those individual index stocks, and you start seeing the stocks that fail to make that lower low. You are seeing underlying accumulation that doesn't get picked up by anybody else. If you watch CNBC yesterday, I was watching, it's amazing. They're all shocked that the dollar rallied like it did. They're all like flabbergasted. Can you believe what just happened? Look at the dollar. This is amazing. Where did this come from? And literally, you have sat with me on a daily basis, and we basically broke it down to minute details as to why it should go up and where it should go. And if for no other reason, when you watch these CNBC type shows, watch them just for that sheer enjoyment, because we have been calling this thing to these levels for a year and a half. And now we're here. And again, all these people are supposed to be the professionals. They're supposed to know what's going on. Don't listen to anybody else. Even me. Use the tools, go into the analysis, and come to your own conclusion. And come hell or high water, stick with it. That's why I don't want to do a lot of responding to people's ideas when they ask me about their trades. Because it's not your trade anymore, it's mine. But if you go in and you find these signatures that are in price, when you see this is a 30-minute chart on bonds. Okay, 30-year bond market. This is the price action. If we look at this and say, okay, I can see, a reflection pattern here, which is something I was talking about in my free tutorials. Turtle soup, sell off. Okay, it runs to equal lows. We can do all that stuff. But what up here at this high? What up at this high here constitutes the expectation and magnitude for this type of move here? Number one, the interest rate announcement that was coming. So you know there's a big move coming. What direction should it go? Well, we were calling dollar higher. We wanted to see a stronger dollar. We believed that they were going to do whatever was necessary to cause the dollar to rally higher, make a new higher high, and it did. So if you look at this, and let's take a quick look at where are we at? Barchart.com, and we'll pull up a 10-year note. And some of you guys that are in here, only Forex traders, and you're looking at this, man, this has nothing to do with why I signed up. You're missing it. If you feel that way, if you think this has nothing to do with what you're trying to learn, you're missing it. You're missing the importance of it all. Because believe me, I could tell you, and I could literally write a book just on that episode alone, the understanding that this gives you is really what I was looking for as a young man in price. But I didn't know it. I didn't know it and didn't appreciate it until 5 years ago, really. I mean, I wish, when it hit me like that, I wish I could, at that moment, I wish I could go back in time and told myself, hey, look, this is the secret. I mean, really, this is the thing that everybody is looking for, but you can't find it anywhere. And I don't know. I mean, I'm a firm believer in God. I believe that God has given me an ability to see these types of things. I've always tried to give credit to things and people that have influenced me as a trader, and I've always been quick to say, no, I didn't have that given to me by anybody else when I'm challenged. But I want you to take a look at this, okay? And you can see the massive distribution pattern that's here. Because we haven't taught all the things that goes along with it, Raj. To implement any small portion of it now would open up a wave of new questions, and I try to resist. And some of you to ask questions, and you'll confirm this. If I'm telling you something that's not true, you call me out on the forum. But many of you have asked me questions about things that haven't been taught yet, and my response is always the same thing. It's either going to be taught in an upcoming lesson for this particular month, or I give you a specific month and when it's going to be answered. Until we get to that content, I'm not bringing it up because all you're going to do is have a million more questions. Okay? So this is their 5-year note. Okay, this is a 5-year note. And as we were going into yesterday, right for the interest rate announcement, look at this high in relationship to the previous day's high. Was the high on the 14th higher or lower than the 13th high? Look again, Kane. Is this high lower or higher than this high? It's lower. There you go. All right, so that's the 5-year. Here's the 10-year. For the 13th, is the 13th high on the 10-year higher or lower than the high on the 14th? We made a higher high on the 14th in the 10-year, right? So right away, without even looking at the 30-year, we already know that we're seeing professional distribution. There's the 5-year. There's the 10-year. That's massively obvious, isn't it? I mean, that's like, it jumps off of the chart. You don't need anybody to draw this for you. It's there. You can clearly see it. See it? Now you have the 30-year really extending itself. Now, by all standards, this looks like a strong uptrend, yep. I mean, perfect. It's trend line. It's perfect. Everything's perfect. Everything's perfect. And gets up here to the 150 level. And then what? At that mark here, it looks like it's strong. It's underlying strength. The bond market's it's strengthening. It's rallying up. Interest rates are dropping. To neophyte, I can tell you back in time, I would have saw that and said, okay, well, they're probably going to cut interest rates. That's what I'm interpreting it as that. I think they're not going to raise interest rates, or they're going to leave. They're going to leave it unchanged, or they're going to cut interest rates. That would have been my analysis as a younger trader looking at just the bond market. But when you take a step back, and you look at price action, okay, well, 30 years saying there's a higher high. The 10 years saying it's a higher high. 5 year says, I don't think so. Think about it. That is massive distribution. When you look at what I was studying initially as a trader, when I was going into the studies of the relationship to the open to close and then the next day's open, which is the basis of how Larry Williams created his accumulation distribution pattern or line or whatever, indicator rather, I had four indicators on my chart when I was a trader when I first started. It was a 50-day moving average, simple 50-day moving average, which I don't use anymore. I used the stochastics. I used a accumulation distribution pattern and a Williams percent R. So I had that on my charts, and I demanded that his accumulation distribution indicator would give me a buy and sell signal every single day. And some of you feel that, like even what you're learning right now, you're demanding an ICT setup every single day because I said there's one there every day. So you're demanding that you are able to see it. So if you can't see it, so what does that mean? If you can't see it, then obviously this stuff doesn't work. So if that's what you're coming to a conclusion, believe me, that's the same thing I felt early on, that there's no validity behind Larry Williams' accumulation distribution formula, that it was contrived. It was an aberration. It would sometimes occur and then sometimes it wouldn't. So therefore, there was no reason to place any statistical evidence behind it that it's valid. That does not occur when you use comparative analysis. When you use comparing likes, okay? I got the idea to import these varied interest rate markets into my S&P trading because of Larry Williams saying, look at compare like markets. And if you read his book, How I Made $1 Million Trading Commodities Last Year, he talks about this. Like, in other words, if you're bullish on commodities, okay, which commodity group is the most bullish? What's the one that's been making higher highs and failing to make lower lows? Because that's the one that's going to have the massive up move. And we're going to talk about that in great detail in the commodity teaching. But when I heard him say this in his videos and when I reread it again in his book, it made so much sense to me that what is that, Mike? What are you asking me? What time do bar charts use? I don't know. I never paid that. I'm looking at just the price action. I'm actually trading off of e-signal data when I'm using the bond market stuff. But I'm giving you a way for you can pull it up yourself this way. So when I went into applying the bond markets like this, it gives me a great deal of validity that's instantaneous. It's unadulterated. It's pure. You see real accumulation and distribution when it happens, as it happens. You can forecast it occurring, and you can anticipate it. And then when you see it in the charts, it gives you a great deal of confidence. Okay, this is going to be a rally on the dollar. So if we add a dollar chart, using bar charts as well, you're going to see how this thing jumps off. That's not what I wanted to do, Michael. But getting back to what I was saying earlier, if I could go back in time, and obviously everyone can say this, but I wish I could go back and tell myself this. Because this is the thing that I think everybody out there that claims to trade with smart money ideas, because it's become a vogue thing in the last 10 years or so. Everybody knows smart money, but nobody's making money. But the idea is really rooted in this. Because if you understand this, and we go into a 5-day chart as well, so it pulls up a 30-minute chart. So here you got the 13th and the 14th, okay? Look what's happening here. Are we seeing a massive lower low in dollar at that 180 level? It's failing to go lower. At the same time that the bond market's making a higher high. By itself, that's enough. That's enough. Right there, that's enough to support the idea that the dollar's going to go higher. Between the bond market and that. Now you want to supercharge the idea, and you want to be able to know 100% that this is a trade idea that has all signatures of smart money behind it. Then you throw in the 10-year and the 5-year. All of a sudden, now you have confirmed professional accumulation in the dollar. Let that sink in for a minute, because it didn't just happen because it was interest rate day yesterday. This happens several times a month. Every single month, there's a significant price move, and I'm leaving you with that homework today. Before we get to Sunday's open, before I do pre-market analysis on a video, I want you to have shared with me, okay, not on Twitter. Please don't send me charts, okay, on Twitter, because I don't want this information shown about, okay, because there's a lot of folks that are following you all, and literally when you tweet to me, everybody has to do a search on my Twitter, and they can all read what you're tweeting to me. So if you're giving sensitive information, you're just basically teaching the content. You know, it doesn't take long for someone to pick up what we're doing after a while. But I want you to go through the charts, okay, and see. Here's the cool thing. Don't just do it with Forex. Do it with Bitcoin. Do it with commodities. Do it with stocks. Do it with indices. And you tell me if it isn't telling you when there's a massive footprint coming in and you got to be either in that same side or get out of the way, because you don't want to be offside on a move like this because it'll crush you. When we anticipate certain higher time frame levels that are nested, like a monthly and a weekly, if that order block is nesting and you see that same returned level on a daily, there's a strong expectation of this type of pattern to come into way. In other words, it's going to produce this confirmation signal. When you have those things strung together, you have multiple things building a confluence of things and converging on one idea. When you have that, it builds a great deal of confidence about the trade that you're going to take or are in. And as long as that is present, you hold the trade and you look for objectives to keep reaching for farther targets out. But for the biggest moves that take place in the marketplace, the ones that always have that explosive nature, every single one, go back and look at every single one. This hallmark signature between the 5-year, 10-year, and 30-year, that's always there. It's always there because interest rates are what makes everything move. Everything. And you can do the same thing with the bond. You can do, there's different German interest rates as well, just like there's a 5-year, 10-year, and 30-year. There's varying times for the German notes. And you do the same thing with that. And admittedly, if Tom Dante did that, he wouldn't have the difficulties have. And I'm not beating up Tom. I'm just saying, in all due respect, and I've actually mentioned this, so it's not like I'm trying to keep the secret from him. I've told him if he would compare, the relationships of the varying German interest rate markets, it's there too. It's not just signature to just this. So when we have an idea, and Steve, I see your question about can we get to directional bias with the triad? The triad, the interest rate triad, has the ability to confirm or negate your directional bias. You still have to do the homework and determining, okay, I'm at an order block on a monthly or a weekly or a daily. So should there be some buying in here? Okay, we'll go in and get an X-ray view behind price and see if this pattern here in the interest rate markets are there. Because if it supports it, then you probably have a loaded deal. It's probably going to be a buy. Then you can go in and look in time of day and do all the things we do in terms of trading it. If it's a setup that's across the board for a weekly range, then you could be a buyer around Monday and Tuesday and hold on to it for Thursdays, the New York session, to Friday's open. There's all kinds of. I don't want to force a model on you. I don't want to do that. I'm going to share with my group that's here in August of 2017. You will actually have my personal trading plan. And I'm only confident in sharing that with you because I know it's never going to stop working. If I ever believed that you would never have this information, it never happened. It wouldn't happen. But because it's based on mechanics that are never going to fall out of favor, think about it. If a large institutional body comes into the marketplace and they're buying something, it's impossible for that price to go lower because of the sheer vastness of their orders buying it. It can't go lower. Same thing is being said when they're selling it. That's what you're seeing. You're seeing massive distribution in the interest rate market. They're building a premium in the 30-year because that's the largest one that's traded. The most liquidity is up here. You're going to find that the 10-year and the 5-year, usually that's the one that diverges. The 30-year that's the show pony. They put all the lipstick on the 30-year. The 30-year looks strongest at its highs and looks most weakest at its lows. But behind the scenes, you have to measure what the 5-year and the 10-year is doing at the same time. When you get to that point in which now You have a signal, you have a setup, you have a condition, you have an underlying premise behind the marketplace. You think that the market's going to act accordingly. It's going to move higher. Okay, great. If that's the case, go into the bond market and see if that validates that setup. If there's no divergence at the lows or divergence at the highs, okay, what you're actually doing, and here's the bottom line right here. We go into trading with the hopes and aspirations that these indicators, and there's many of them, okay, bar chart, you can do all these things down here. You add all these wonderful little things to distract you from the thing that matters most, price. All these things I've had on my charts at one point over time. I've had it all there. I did all those things. Think about that same expectation you have for the indicator that you adopted and loved and fell in love with, and you still probably have them on your chart. You just don't share them with me when you share a chart. Get all that stuff off your chart. That same expectation that you had or have for that indicator, use that same mindset with the interest rate triad. Use the bond market as your indicator. That's what the indicator is. You're indicating that the bond market is supporting or negating your trade idea. Think about it. All you have to do is inversely relate it to the dollar, though, and then you'll have it. It opens up like a lock. All the pin tumblers connect perfectly and allows you to unlock it, and then you're able to see these big moves come in play. I mean, literally, we talked about this occurring before the interest rate announcement, the underlying levels, why it should do it. And I told you when I talked about these interest rate triads that you go into the marketplace and you look for these things at the time when you anticipate a big move. These are not happening in the small little moves, okay? These little minor little fluctuations, you're not going to see a signal there. So I know what's going to happen. Invariably, you're all going to go in and say, okay, I'm only going to look at the bond markets, and I'm going to have these 3 charts up across my charts, and every 5 minutes I'm going to keep doing this. I'm going to keep looking for that divergence. As soon as I have a divergence, that's what's going to give me the buy signal or the sell signal. That's not how you do it. That's not what you're doing, okay? You're looking at monthly, weekly, and daily levels. That has not changed. That has not changed. You start from that perspective because that's where the funds are trading. You are trading the ranges and the new levels of external liquidity based on what the large funds are doing. And you're not going to understand what I just said there, but at the end of the mentorship, when you read this, when you rewatch this video, you're going to say, I know exactly what he's talking about now. And that's the reason why I can't jump too far ahead in the content, because you're not going to understand 15 new things. I got to go small pieces at a time, because all of you are going to learn at a different pace. And also, I have to control the inflow of all these questions. Because at some point, if I'm inundated with so many questions and I don't ever respond to them, it equates to poor service. And that's not what I'm trying to do. I'm trying to teach you how to look at price. That's what this whole thing is about. When you understand how price is delivered and what makes these big moves, why do they occur? What reoccurring themes are there? That way, when I say, this is what we're looking for, this is what should be expected, you'll go and you'll see it, and then you'll trade accordingly. And it's not me telling you to take the trade. It's you doing it on your own, and it builds immense confidence. And you'll know exactly what it is you're looking for, and you'll know when not to take the trade, because if the interest rate markets are not validating that setup, don't think that it's only on the 30-minute chart either. Like, if you can take this down into 15-minute time frames, and it still is there for intraday trades. Like I told you, I did it with 5-minute charts for my S&P trading and 1-minute charts for S&P trading. I used 1 and 5-minute charts for S&P trading, and the bond market divergences still work on those lower time frames like that. And again, I'm saying that only to tell you that it is so strong and so potent. I didn't think outside the box that I created for myself as a day trader. I only used this information between 9:30 in the morning open, when the equity markets started trading, until 11 o'clock in the morning. Then I stopped paying attention to it until 1 o'clock in the afternoon, till 4 p.m. close of the equity market, the morning trend and the afternoon trend. And I didn't believe at the time that it had any substance to it outside of those two little tiny bookend of times, of spans of time. So the point is, if we can remove all of the other things that distract us and hone in on the very thing that makes the markets move, and if you, I got a collection of video clips that I've always referred to when I see certain people defend a certain principle of trading, or the author of them themselves say, you know, this is the way, or this is the secret of it all, or this is what makes this happen, and this is why the markets do this. You're looking at why the markets move right here. This is what makes the markets move. Interest rates. My audio still here? Okay. Yeah, if you lost audio, it's on your end. Sorry, buddy. You'll catch it on the recording. But anyway, I bring this to you today as a reminder that it's not just looking at the dollar index. It's not just looking at the relationship of correlated pairs. Think about how much validity, okay? If you had a grading system. Now, when I first started trading commodities, I had like a grading system that would give me a strong buy, a neutral, to a flat buy, or sell strong, or a neutral to flat sell. And I would grade my trades like that. And I'd like to see things that would contribute to a allocation to a strong buy or a strong sell. And I would avoid things that would give me a neutral state for a trade, or if it wasn't really clear or really had a lot of things behind it. And I had a checklist of things I would use, and it was 10 things. And if I had 8, or more behind that trade, I would trade it. And commodities, you didn't have a whole lot of setups. You just didn't back then. At least for me, I didn't have a lot of setups. Now today, there would be all kinds of setups, but as a new trader, I didn't have all those ideas and things I have now. But I had a checklist of 10 things I would look for, and if I had 8 or more, that's like a strong buy. If I had 6 or more, it would be a neutral to okay buy, and I would see it, I would monitor it and see if it would give me more information, and sometimes I would miss moves. But think about it like this: if we were able to go down a short checklist right now in closing, if we have a trade that has a directional bias for the dollar to go higher, okay, or our belief is we think the dollar's going to go higher. There's some reasons to see dollar go to 104. Okay, our belief is that when price is at 100, we think that the dollar is going to go 104. Okay, great. What other things behind the scenes justify that? Okay, are we seeing a breakdown in the bond market? Yes. At the time we wanted to be a buyer of the dollar, is there weakness, okay, in any of the foreign currencies, signaling it early? And here's what you look for: the strongest up move currency, and you look for the weakest currency. And by taking those two currencies, and well, I'm getting ready to jump ahead. You look for relative strength between them. If you can see that there's a reason to expect the dollar to go higher, and the bond market is showing what we're showing here, the triad divergence, okay, that right there is two things, two very, very strong things. The dollar, that's king, okay? If the dollar's going to go higher, everything else is going to bend the knee, so foreign currency is going to decline. If we see the bond market showing willingness to go lower, and it's diverging bearishly at its highs, like we've shown here with the varying 10-year, 30-year, 10-year, and 5-year note, okay, it's showing massive distribution in the debt instruments. So if that's what's being seen here, and you see a correlated pair divergence, that means if the euro makes a lower low than the cable, but the cable doesn't make that lower low at the same time that the dollar made a higher high. Let me make sure I said that right. Look for a bullish dollar. So we would be seeing the euro make a higher high, but the cable makes a lower high. So it's failing to make a higher high. So there's distribution in the cable. Dollar could make that lower low. It could. If we see the divergence in the interest rate market here, that's confirming, even though that the lower low in the dollar, when we're bullish, it's just taking the sell stops below the marketplace. And you combine all these things and you have a checklist. Okay, then you would have bullish dollar as your underlying premise. You have the interest rate market breaking lower and also making failed higher highs. So there's three things in your checklist there that's going in your favor. Then you look at the foreign currencies and you're seeing divergence at the highs. Euro makes a higher high, cable fails to make a higher high. You have correlated pair SMT divergence right there. And cable to dollar would have a USDX divergence. You got 5 things there. You have 5 underlying fundamentally driven, I'm going to use the word here, fundamentally driven and technically sound expectation of the marketplace. You could be selling foreign currency and buying the dollar in that instance. If you look for setups to have that hallmark to it, you're never missing that next big move. Don't believe me? Go back and look at your charts. Go back as far as your data will allow you, and you'll see that that is the underlying quote-unquote smart money signal. That's the one that evades everybody. It evaded me for years. It evaded me for years until I used what I learned in the short-term time frames with the S&P and bond trading. And I'm just going to tell you like this. My bond trading, I would buy, okay, in other words, I would sell short the 30-year Treasury bond when I saw this pattern right here. I see a lower high in the 5-year, a higher high in the 10-year, and I see the higher high in the bond market, the 30-year bond market. I would sell short there. And all I was looking for is a move from the previous low that made that range. I wanted to get back to the midway point. That was my objective. That's it. It's all my bond system was. I used a 3-year variation plus one more 2-year. So I had a 2-year note, a 5-year note, a 10-year note, and a 30-year note. And if I was trading a resistance level, and I hit that resistance level on the bond market, and I saw the 10-year or 5-year or 2-year note fail to make that higher high in concert with the 30-year note, I went short there, and I used the 30-year market from this low to this high. If I went short, I would have already been out right here. And yes, I would have missed all that move, and I didn't care. But I had 90+% accuracy using that, and I was trading every single week. Every single week. Like clockwork. I didn't know how powerful of the information I was using at the time. In my maturity as a trader, I can look back and say, wow, I thought I had it all figured out. And I was literally standing. I was standing on a golden goose's back. I had no idea. But now you do. You have amazing, amazing information now laid in your lap that isn't found anywhere else. It's not found anywhere else. No one teaches it. No one talks about it. I didn't learn it from some gurus, and I didn't learn it from the banks. No one taught me this. I discovered it in my own studies. And once I understood the importance of these interest rate markets, it unlocked everything else. And now it's up to you to develop that same affinity for it like I have. Because I literally wish I could go back in time 20 years ago and sit down myself and smack me outside my head and say, hey, look, this is what you're looking for, and don't mess around with anything else until you figure this out. Once I did that, it's all over the place. You can see every major significant price move because of this. And I had to create names for it because there's nothing else I can say. Oh, it's this. Oh, it's that. There's nothing like what you're learning with this. And I'm not saying because I'm beating my chest. I'm just saying that I'm so blessed to have learned it and be able to use it. And once you understand it, it gives you the freedom to sit on your hands until this thing, this element, is behind the trade. If this doesn't have this behind the trade, guess what you have? You have a suspect trade. So if we can differentiate when the market has a high odds probability of moving because of these characteristics, then we can feel confident going in and trading it. If it doesn't have it, or maybe it starts to have it, but then it falls away quickly and then the divergence goes away, what does that mean? Kill the trade. Don't even think about it. Just kill the trade. Collapse it. And it means if you have a minor loss, so what? If you have a minor profit, get out. Just get out. If it's at break even, just get out. Get out. Collapse the trade. When you have these elements with the interest rate triad behind your trades, you're going to see massive price displacement because there's no other way for it to not happen. I mean, you got big entities behind that move. And you're never going to hear about it before the fact, okay, but you can see their footprint. They can't hide it. Never be afraid, because I'm sharing it with you. Never, ever, ever be fearful that this is going to stop working. I'm telling you, don't be fearful of that, because it can't happen. It cannot happen. It's a constant. Because of their volume, they will not. They're massively selling the 5-year note. It's on the short end of the curve. They're massively distributing the 5-year note. That's why it can't go higher. They don't want to buy the 5-year note, but they'll buy on the 30-year because everybody's got to do what with housing? You got to buy a mortgage. Most people can't go out and pay cash for their house. So they're using this, okay? They're building this in on the interest rate market that's most widely followed, the 30-year benchmark. That's why it's got its name, the 30-year benchmark. Everyone concerns themselves with the 30-year. But the clue behind the interest rate market is looking at the difference between the short term, intermediate term, and the long term. Once you have that, it's over. It's over. It's game over. It's done. You now have evolved to a different type of trader that gives yourself the clarity. And here's the wonderful thing that most of you are lacking right now. It gives you patience. What am I waiting for, Michael? You say be patient. What am I waiting for? You're waiting for this to be behind your trade. If you have this element behind your trade, great. Then you can proceed to go forward. If you don't, then you wait. You simply just wait. And you're not going to get a trade every single trading day in your particular pair. But you'll get the significant price swings that you're looking for if you wait for it. If you go across all the majors, you will find every significant price swing has this element behind it. And there is nothing else I could say beyond that. And if it didn't floor you today, then you're dead. Really, there's nothing, you can't walk away from this and say anything but, wow, that it's clear. It's understandable. It makes sense. It's easy to see. It's visual. It doesn't require acrobatics. It doesn't require a whole lot of ambiguous things. Okay, if at resistance, you're going to see a failure swing. In other words, at resistance at the dollar. At the dollar at resistance, you're going to see failure swings at the lows in the interest rate markets. You're going to see a lower low that's not met by another lower low in the interest rate triad. And that means that you have a real strong resistance in dollar. Expect lower dollar. Expect higher interest rates. And that's the reverse of what we're showing here. All right, well, that's all I have for you today. It's like I said, it's a pleasure and it's an honor for me to be able to sit down with you guys and share this with you. Some of you have grown in appreciation in your own private studies since I've shared this stuff, and I look forward to more of that as well. We're gonna do a live session tomorrow in the New York session, so I'm going to give you a link to be a part of that tomorrow. It will be the last live session where I would be participating in trading until probably the third week of January, but that does not mean we will not have live sessions like we're doing here. We're doing teachings and stuff. Participation in the marketplace will be placed on the sidelines because of holiday volume, and classically I'm already out of the markets around Thanksgiving. Admittedly, I'm not trading usually at all at this time of year. But I have to do things to keep you guys engaged, because otherwise you get bored or whatever. But you have a lot of content coming to you for December still, and then in January we kick it up a notch and start breaking down how we actually mold all this stuff into trading pattern, not trading pattern, but trading plans. What to do day by day. What do you do at the beginning of the day? What do you do at the beginning of the week? How do you record this stuff? How do you log it? What are you supposed to do specifically? I'm actually giving you all those big building blocks that nest together in August, where you actually get a PDF file from me. It's a flow chart. You do this, 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 and it arrives at your entry, exit, management, all that stuff. So until I talk to you guys tomorrow, have yourself a pleasant afternoon, and keep your eye on what's going on with this election in the U.S., because I honestly believe that there's something really distasteful about to take place. And even if it doesn't, we have amazing volatility coming in 2017. So with that, I wish you good luck and good trading.